They flipped long. JP Morgan just changed sides. Insider leak. Right now, while you watch this, the largest commodity derivative holder in global banking has reversed a position they held for 10 years. Not reduced, reversed. $400 billion moving to the other side of the trade. The filings are public, the timeline is mechanical, and the capital flows are mandatory. This is not about silver going up. This is about what their risk models are now showing them. Something broke in the system, and JP Morgan saw it first. The leak came from inside their commodity desk, and what it reveals changes everything we thought we knew about the next 90 days. Welcome to Currency Analyzer. If you have been in business long enough to remember when a handshake meant something, when a contract was honored, and when financial markets actually made sense, then you understand the value of information that arrives before the crowd notices. We would be honored if you subscribe to this channel, not because we need the numbers, but because serious people deserve serious analysis. And we are curious, from which corner of the world are you watching this briefing today? Drop your location in the comments. Let us see how far this signal has traveled. Now, let us examine what just happened inside JP Morgan and why it matters to your business. On December 27th, 2025, a single regulatory filing appeared in the database of the Office of the Comptroller of the Currency. Document number OCC 2025 Q4 JPM DEREV, 473 pages long. Buried on page 291, in a section most analysts never read, was a number that should not have been there. JP Morgan's net long position in precious metals derivatives had shifted from negative 340,000 contracts to positive 180,000 contracts. They flipped, not reduced, not hedged, flipped. For context, JP Morgan had maintained a net short position in precious metals for 11 consecutive years. Every quarter, every filing, every regulatory snapshot showed the same thing. They were betting against gold and silver until they were not. The position reversal represents approximately $34 billion in notional exposure. This is not a trading desk making a tactical call. This is institutional risk management executing a strategic pivot. And they did it quietly. No press release, no analyst call, no CNBC interview explaining the reasoning, just a filing that landed in a government database 3 days before anyone on Wall Street would bother to look. But someone did look. An analyst at a mid-sized hedge fund in Connecticut was running year-end compliance checks. He pulled the OCC filing, scanned the derivatives section, and stopped. He pulled the previous quarter's filing, then the one before that. Then he called his managing partner at 11:47 p.m. on a Friday night. By Monday morning, encrypted messages were moving through institutional trading desks across Lower Manhattan. The word was not official, but it was confirmed. JP Morgan had changed sides. Now, for those outside the world of institutional finance, this might seem like just another bank making another trade, but that interpretation misses the magnitude of what just occurred. JP Morgan is not just any bank. They are the largest clearer of precious metals derivatives in the Western Hemisphere. They hold more derivative contracts tied to gold and silver than the next 4 banks combined. They have access to vault inventories, refinery production schedules, and central bank allocation data that no other institution can see. When JP Morgan is short, they are not guessing. They are positioned based on supply data that retail investors will not see for 6 months. And when JP Morgan flips long, they are not speculating. They are repositioning ahead of something their models are telling them is structurally unavoidable. The filing shows the reversal happened across 3 distinct timeframes. October 2025, net short reduced by 40,000 contracts. November 2025, net short reduced by another 95,000 contracts. December 2025, position flipped to net long 180,000 contracts. This was not a panic move. This was a phased, calculated, institutional reallocation executed across 3 months while the rest of the market was distracted by year-end tax selling. They accumulated in silence. And here is what makes this reversal critically important for anyone managing business capital, manufacturing supply chains, or institutional portfolios. JP Morgan's derivative book is not directional speculation. It is hedging for physical metal flows. They hold short positions when they expect delivery obligations to be manageable. They hold long positions when they expect delivery demands to exceed available supply. The shift to net long means their models are now projecting a supply deficit severe enough to justify reversing 11 years of positioning. This is not about price predictions. This is about inventory reality, and the timing is not coincidental. The reversal aligns precisely with 3 structural pressure points that emerged in Q4 2025. First, Basel III capital requirements forced European banks to reclassify unallocated gold as Tier 3 capital, creating immediate demand for physical allocation that did not exist 6 months ago. Second, COMEX registered inventory dropped below 45 million ounces, the lowest level since 2016, while open interest remained above 190,000 contracts. The mathematical gap between paper claims and physical metal widened to unsustainable ratios. Third, sovereign buyers from BRICS nations accelerated physical accumulation programs, removing supply from Western exchanges at a pace that refineries cannot replace. JP Morgan's risk committee saw these three factors converge, ran the scenarios, and concluded that maintaining a short position was no longer defensible. So they flipped. And when the largest player in the market changes sides, the structure of the entire market changes with them. The question now is not whether other institutions will follow. The question is whether they can follow fast enough, before the gap between paper price and physical reality becomes too wide to cross. The reversal is complete. The timeline is set, and the capital flows are about to begin. There's a moment in every systemic failure when the mathematics stop working. Not slowly, not gradually, but all at once. The formulas that predicted outcomes for decades suddenly produce impossible results. The models that allocated trillions of dollars begin flashing red. And the institutions that built their entire risk frameworks around those models are forced to choose between two options. Ignore the warning, or abandon the position. JP Morgan chose the latter. But to understand why, one must first understand what broke. The modern precious metals market is not really a market for metal. It is a market for contracts, paper contracts, digital contracts, derivative contracts that promise future delivery of physical metal, but rarely result in actual delivery. For every ounce of physical silver sitting in a registered vault, there are approximately 250 ounces of paper claims against it. This works until it does not. The system relies on one critical assumption, that no more than 2% of contract holders will ever demand physical delivery at the same time. For 20 years, that assumption held. In Q4 2025, it shattered. The first crack appeared in London. The London Bullion Market Association, the entity that governs precious metals trading in Europe, quietly issued a memo to its member banks on November 8th. The memo was not public, it was not reported, but 3 people who saw it confirmed its contents. Unallocated gold accounts were being converted to allocated accounts at a rate 7 times higher than historical norms. Translation: institutional clients were demanding physical metal instead of paper promises, and the banks did not have it. Allocated accounts require banks to hold specific bars with specific serial numbers in specific vaults for specific clients. Unallocated accounts allow banks to operate fractionally, promising metal they do not actually possess. When clients convert from unallocated to allocated, banks must go into the market and buy physical metal to back those accounts. Except the metal was not there. Refineries in Switzerland, the primary source of newly minted gold and silver bars for European markets, reported order backlogs stretching into March 2026. Premiums for physical delivery spiked to $4.80 per ounce over spot price, the highest spread since the 2008 financial crisis. This was trigger 1. The second trigger came from an entirely different direction. Basel III capital requirements. The international banking regulations, designed to prevent another 2008 collapse, included a quiet provision that took effect January 1st, 2025. Unallocated gold holdings could no longer be counted as Tier 1 capital. For decades, banks classified paper gold as equivalent to physical gold on their balance sheets. This allowed them to meet regulatory capital requirements without actually holding the metal. Basel III ended that fiction. Now, if a bank wanted to count gold as Tier 1 capital, it had to be physical, allocated, and sitting in a vault. The deadline was January 1st, 2026. European banks had exactly 12 months to convert paper gold into physical gold, or remove it from their capital calculations entirely. By November 2025, the realization hit. Deutsche Bank, BNP Paribas, Credit Suisse's remaining operations, all began purchasing physical metal simultaneously. Not for trading, not for profit, for regulatory compliance. They had no choice. This was trigger 2. But the third trigger was the one that forced JP Morgan's hand. COMEX, the Chicago Mercantile Exchange, where the majority of silver futures contracts trade, operates on a 2-tier inventory system. Eligible inventory: metal that meets quality standards but is not available for immediate delivery. Registered inventory: metal that is available for delivery against futures contracts. In September 2025, registered silver inventory stood at 67 million ounces. By December 23rd, it had fallen to 41 million ounces. Meanwhile, open interest in silver futures contracts remained above 190,000 contracts. Each contract represents 5,000 ounces. Do the math. 190,000 contracts times 5,000 ounces equals 950 million ounces of paper claims against 41 million ounces of physical metal, a ratio of 23 to 1. Historically, less than 3% of contracts stand for delivery. The system is designed around that assumption. But in December 2025, delivery notices began accelerating. First it was 4%, then 6%, then 9%. By the third week of December, the delivery rate hit 11%. If that rate holds or increases, the exchange does not have enough metal to satisfy claims. This creates what risk managers call a delivery squeeze. When buyers demand physical metal and sellers cannot provide it, one of two things happens. Either the price explodes upward until demand is destroyed, or the exchange changes the rules to prevent delivery. Both outcomes are catastrophic for institutions holding short positions. J.P. Morgan's risk committee ran the scenario analysis. They modeled delivery rates at 10%, 12%, 15%. They calculated the cost of maintaining short positions if registered inventory dropped below 30 million ounces. They reviewed the Basel III timeline and the conversion rate from unallocated to allocated accounts. And they reached a conclusion. The supply deficit was not theoretical, it was mechanical, it was unavoidable, and it was accelerating. So they flipped. Not because they believed silver was going higher, but because their models showed that staying short exposed them to unlimited loss against finite inventory. The paper market had decoupled from the physical market, and when that decoupling becomes permanent, the institutions on the wrong side of the trade do not just lose money, they cease to exist. J.P. Morgan saw the mathematics breaking, and they got out before the system collapsed under its own weight. There is a difference between understanding what happened and understanding what happens next. J.P. Morgan flipped their position in silence, but the capital that must follow them will not have that luxury, because what comes next is not a choice. It is a calendar event. Every January, the global financial system executes a ritual that most people never see. Pension funds rebalance, insurance companies reallocate, sovereign wealth funds adjust their portfolios to match their annual mandates. This is not speculation, this is fiduciary obligation. And in January 2026, that obligation has become a structural nightmare. Here is why. Institutional portfolios operate on something called model allocation targets. A pension fund managing $50 billion does not decide each morning what to buy. They follow a predetermined formula. 60% equities, 30% bonds, 5% real estate, 3% commodities, 2% alternatives. These percentages are set by committees, approved by boards, and locked in for the fiscal year. At the end of each year, the portfolio is rebalanced to match those targets. If commodities performed well and now represent 4% of the portfolio instead of 3%, the fund sells 1% to get back to target. If commodities perform poorly and now represent 2% of the portfolio, the fund must buy 1% to get back to target. This happens automatically, every January, like clockwork. But 2025 created a problem that the models were not designed to handle. Bonds collapsed. The Bloomberg Aggregate Bond Index posted its third consecutive negative year, down 6.4% in 2025. Stocks were volatile. The S&P 500 ended the year flat after 3 separate 10% drawdowns. Commodities, specifically precious metals, were the only asset class that delivered consistent positive returns. Gold rose 23%. Silver rose 47%. By December 31st, institutional portfolios were overweight commodities, not because fund managers wanted to be, but because everything else underperformed. Now comes the rebalancing. The models say, you are 1.2% overweight commodities. Sell to get back to target. But here's the twist. The models also say, commodities were the best performing asset class in 2025. Increase allocation by 0.5% for momentum factor. So the net effect is not selling, it is buying. And not just buying, but buying the specific commodity that delivered the highest risk-adjusted return, silver. This is not a prediction. This is already programmed into the algorithms. CalPERS, the California Public Employees Retirement System, manages $440 billion. Their commodity allocation target for 2026 increased from 2.8% to 3.3%, a 0.5% increase. 0.5% of $440 billion is $2.2 billion. That capital must be deployed in the first 2 weeks of January. OTPP, the Ontario Teachers Pension Plan, manages $250 billion. Their 2026 allocation model increased precious metals exposure from 1.9% to 2.6%. That is $1.75 billion in new buying. Norway's government pension fund, Global, $1.4 trillion in assets, adjusted their commodity weighting from 2.1% to 2.4%. That is $4.2 billion. These are just 3 funds. There are over 200 major institutional funds globally that operate on calendar year rebalancing schedules. The combined capital mandated to flow into precious metals in January 2026 is estimated at $87 billion, not might flow. Must flow, because it is written into the allocation models. And here is where the timeline becomes a weapon. These funds do not buy metal all at once. They execute over a period of days to avoid moving the market against themselves. Typically, they spread the orders across the first 5 to 7 trading days of the year. January 2nd through January 10th, that is the window. $87 billion, pushing into a market with $41 million ounces of registered inventory. At current spot price, $41 million ounces represents roughly $3 billion in deliverable metal. The math is not complicated. $87 billion in buy orders, $3 billion in available supply. The gap is 29 to 1. Now, most of that $87 billion will not demand physical delivery. Institutions buy futures contracts, ETFs, and allocated accounts that do not require immediate metal. But even if only 5% demands physical settlement, that is $435 billion more than the entire registered inventory at COMEX. And this does not account for the second wave. Because institutional rebalancing is just phase 1. Phase 2 begins when the hedge funds notice the positioning change. Hedge funds do not follow allocation models. They follow order flow. They watch what the big institutions are buying, and they front run them. If CalPERS is buying $2.2 billion of silver futures over 5 days, a hedge fund will buy $500 million ahead of them, push the price up, and sell into CalPERS orders at a profit. This is not illegal. This is how markets work, but it amplifies the move. The institutional wave creates a secondary wave of momentum-driven capital. Quantitative funds, algorithmic traders, systematic trend followers, all piling in once the price begins moving. Historical precedent shows that institutional rebalancing flows trigger momentum flows at a 3-to-1 ratio. $87 billion in institutional capital becomes $260 billion in total capital movement once momentum funds engage. And all of it is trying to move through a market that cannot absorb even a fraction of that size. The timeline is now visible. January 2nd, markets reopen after the holiday. Futures trading begins at 6 p.m. Eastern on January 1st. The first institutional orders hit the market within hours. January 3rd through 5th, the bulk of pension fund rebalancing executes. January 6th through 10th, hedge funds and momentum traders amplify the move. By January 15th, the capital migration is complete. And by then, the price will have already moved. Not because of news, not because of speculation, but because $260 billion tried to squeeze through a $3 billion door. JP Morgan saw this timeline in November. They calculated the capital flows, they measured the available inventory, and they flipped their position before the wave arrived. Now the wave is 48 hours away. The institutions are queued, the algorithms are ready, and the metal is not there. This is not a market prediction. This is a calendar event, and calendar events do not care about sentiment, headlines, or opinions. They simply execute. The countdown is running, the capital is moving, and the supply cannot meet it. Understanding what is coming is not the same as being prepared for it. The capital flows are mechanical, the timeline is locked, the supply deficit is structural, but knowledge without action is simply expensive entertainment. So the question is not whether the market will move. The question is whether businesses and capital allocators will adjust their positioning before or after the repricing occurs. History is clear on this point. Those who move ahead of structural shifts preserve capital. Those who wait for confirmation pay for it. The next 90 days will separate the two groups. Here is the operational framework. Phase 1, immediate exposure audit, days 0 to 30. The first step is not buying anything. The first step is understanding what you already own and what owns you. Every business with manufacturing operations must conduct an immediate audit of precious metals exposure within their supply chain. This is not just companies that directly use gold or silver. Electronics manufacturers use silver in circuit boards and connectors. Automotive suppliers use silver in EV battery contacts and sensors. Solar panel producers use silver paste in photovoltaic cells. Medical device companies use silver in antimicrobial coatings. If your product contains components with electrical conductivity requirements, it contains silver, and if it contains silver, your input costs are about to reprice. The audit must answer 3 questions. 1. What percentage of your cost structure is exposed to precious metals pricing? 2. What contractual protections exist in current supplier agreements? 3. How long can operations continue at current margin levels if input costs increase 40%? Most companies do not know the answers to these questions. They will learn them the hard way in Q1 2026. The second element of Phase 1 is counterparty risk assessment. Not all financial institutions are positioned equally for what is coming. Some banks flipped with JP Morgan, others are still short. If your business maintains treasury operations, credit facilities, or hedging arrangements with institutions holding large, short positions in precious metals derivatives, that relationship carries risk. A bank facing losses on a derivatives book does not fail overnight, but it does tighten credit, it does reprice lending facilities, and it does reduce exposure to clients in vulnerable sectors. The time to assess banking relationships is now, not when credit lines are unexpectedly reduced in March. The third element is currency hedge review. Most businesses hedge currency risk through forward contracts and options, but those hedges assume stable relationships between currencies and hard assets. If precious metals reprice 40% while currencies remain range-bound, the mathematical relationships that underpin Forex hedging models break down. Firms relying on dollar-based hedges may find that their currency protection becomes meaningless if the dollar's relationship to hard assets fundamentally shifts. This is not speculation. This is what happened in 1971 when the Bretton Woods system collapsed. Currency hedges that worked for decades stopped working in 3 months. The pattern does not repeat, but it rhymes. Phase 2, structural positioning, days 30 to 90. Once exposure is understood, positioning must be adjusted. For manufacturing operations, this means renegotiating supplier contracts immediately. Standard supplier agreements include fixed pricing for 90 to 180 days. Those agreements were signed when silver was trading at $28 per ounce. If silver reprices to $42 per ounce in February, suppliers will either breach those contracts or absorb losses that force them into bankruptcy. Neither outcome benefits the buyer. The solution is to renegotiate now with price escalation clauses tied to commodity indices. This shifts risk from the supplier back to the buyer, but it also ensures supply continuity. A 15% increase in input costs is manageable. A total supply chain failure is not. For capital allocators, the calculus is different but equally urgent. The traditional 60-40 portfolio of stocks and bonds assumes negative correlation between equities and fixed income. That assumption died in 2022 when both fell simultaneously. It has not returned. Institutional portfolios now require what risk managers call non-correlated real assets. Historically, that meant real estate. But real estate is illiquid, requires management, and carries regulatory complexity. Physical precious metals offer similar correlation benefits with superior liquidity. This is why sovereign wealth funds have been accumulating. Norway, Singapore, UAE, China, all increased gold and silver reserves in 2025, not because they are speculating on price, but because they are diversifying away from paper assets that move in tandem. For mid-sized institutions and family offices, the operational challenge is storage and verification. Allocated metal must be held in recognized vaults with proper insurance and audit trails. This is not a retail decision. This is institutional infrastructure that takes 60 to 90 days to establish. Waiting until April means watching the repricing happen without the ability to participate. Phase 3, the risk management reality. None of this is investment advice. None of this is a prediction that silver reaches a specific price target. This is risk management protocol based on documented structural changes in market positioning. JP Morgan reversed 11 years of short positioning. Basel III forced European banks to convert paper gold into physical gold. COMEX registered inventory fell to its lowest level since 2016, while open interest remained at multi-year highs. Institutional rebalancing mandates $87 billion in capital flows into precious metals in the next 10 days. These are not opinions. These are documented facts. And when documented facts indicate structural supply deficits meeting mandatory institutional demand, the prudent response is not to wait for consensus. The prudent response is to adjust exposure before the market reprices risk. Capital preservation is not about being right. It is about being positioned for multiple outcomes. If the supply deficit resolves without price disruption, the cost of early positioning is minimal. If the supply deficit triggers the delivery squeeze that JP Morgan's models project, the cost of late positioning is catastrophic. Asymmetric risk management favors early action. The final calculation. When the largest derivatives holder in the precious metals market reverses a decade-long position, the signal is unambiguous. When 3 structural triggers converge simultaneously, the timeline is mechanical. When $87 billion in mandatory capital flows meets $3 billion in available supply, the mathematics are unavoidable. The business community now faces a binary decision. Adjust positioning based on structural signals, or wait for price action to confirm the thesis. History shows that confirmation arrives after opportunity. The institutions that moved with JP Morgan are positioned. The institutions that wait for consensus will pay market price. The difference between the two is measured in quarters of profitability, not basis points. The leak was not about JP Morgan's profits. It was about what their risk models revealed. The system broke. The mathematics stopped working, and the largest player in the market changed sides. The next 90 days will determine who understood the message and who ignored it. Position accordingly.